Everyone is talking about the stock market, but almost nobody is talking about the tax mistakes that could cost investors thousands. The stock market in the US has become quite volatile recently. The issues causing concern to investors include interest rates, inflation, valuations of AI stocks, and actions of the Federal Reserve. Today it is up and tomorrow it is down. And that is the problem. Most investors think only about profits. Only a handful know about the effect of taxes on their gains. So, what is actually happening? Right now, investors are watching several major factors: interest rate uncertainty, inflation concerns, high valuation in AI and technology companies, global events affecting the economy. Although the market has performed exceptionally well throughout the year, volatility is expected to persist. It is important to get ready, though not to panic. Many people think CPAs only prepare tax returns. That's actually one of the smallest parts of what a good CPA can do. Here are 5 ways a CPA can help investors during uncertain markets. Number one, tax loss harvesting. When some investments generate losses, then those losses can cut down your taxable gains. Rather than just taking the losses, the CPA will help convert a portion of the losses into tax savings. Investors often overlook this strategy entirely. Selling today versus waiting until next year can create very different tax results. A CPA looks at your income tax bracket, capital gains, and capital losses, then recommends the most tax efficient timing. Sometimes waiting just a few weeks can make a huge difference. Investors have an affinity for dividend stocks. Not all dividends are taxed the same way. There are qualified dividends. There are other dividends taxed very differently. Knowing the difference will increase your post tax gains. Retirement accounts are used to lower your current taxes and or taxes in retirement. Selecting one form of account versus another isn't just an investment choice. It is a tax choice. This is probably the biggest mistake investors make. They spend countless hours researching stocks, but spend none on their taxes virtually. Great investors aren't asking the question, how much money did I make? They're asking, how much am I really keeping after taxes? That's where the CPA comes in. Let's look at its very simple example. Consider two individuals, both of whom earn $50,000 from their trading activity on the stock exchange. Individual A does not plan at all and cashes out all his investments. Individual B cooperates with a certified public accountant. The CPA finds capital losses in other investments, advises on the good timing of certain sales, etc. Both individuals earn the same income. However, individual B retains much more net income after taxes than individual A. And that is the difference. And remember, not always about making extra money. Sometimes it's about retaining that extra money. So, what is the biggest lesson here? Market volatility is normal. Nobody can perfectly predict where the market will go tomorrow, but what you can control is your tax strategy. A CPA does not control the stock market. They help you make smarter financial decisions around it. During uncertain markets, good tax planning becomes even more important. If you found this video helpful, don't forget to click on like and subscribe for more simple CPA tricks to save money legally. And here is my question for you. Have you ever invested in the stock market, or are you thinking about starting? Drop your questions or thoughts in the comments below. I read every single comment, and your question might be featured in one of my upcoming videos. Thanks for watching, and I'll see you in the next one.